What should you be doing with your money to get ready? Well, joining us now is Charles Schwab, Chief Investment Strategist, Liz Ann Sonders. Liz Ann, great to have you as always for some perspective.
Thanks, John.
Let me back it up here and ask, how important are both AI spending and the idea of AI spending for this market? And I mean both CapEx from these big tech companies and evidence that they're showing that they're able to monetize that CapEx.
Well, so far so good in terms of the spend and the ability to monetize it. I think what's the open question are the adopters of AI, and at what point will those companies start to put meat on the bones in terms of an earnings benefit or productivity benefit or a profit margin benefit? And that's what that recent MIT survey showed, that the companies that are bringing AI into the mix are not yet seeing anything terribly concrete. So I'm paying attention to both sides of that. I think the other important factor as it relates to the CapEx, John, as you pointed out, the Magnificent Seven as a cohort represents almost a third of all S&P 500 CapEx. The one thing to be mindful of, though, is that free cash flow growth for that same cohort has actually gone from more than 60% positive year over year 5 quarters ago, now into slight negative territory. And you've got, just starting to see an increase in companies that are announcing deals by utilizing debt as opposed to funding it out of cash flow. So those are some nuances that I'll be paying attention to as well.
And so this earnings season, how important is this rule of 40, which is, I guess, the popular term this decade over the last few years to signal how companies are balancing growth versus profitability? If you see that coming in with some of the larger players, does that suggest that the market's starting to pay attention to something different, or that for most companies, that's still going to be really important?
I think it's still somewhat important. I think what is the focus in the aggregate, not just for the AI-related areas like tech and communication services, is the differential between top-line growth and bottom-line growth and the ability to maintain or even grow profit margins. So if you look at so far this earnings season, you've got 4 sectors out of the 11 that actually have a decelerating pace of, or accelerating pace of profit margins, which means 6 have a decelerating pace. 1 is about even relative to last year's profit margin. So in the aggregate, you've got just under 13% profit margins. That's better than expected. Leadership sectors in terms of stronger profit margins. Tech is one of them, but so is financials, so are utilities and basic materials. Actually, the other, kind of duo alongside tech in the world of AI and the mega cap tech-oriented names would be communication services. That actually has a slight deceleration in the rate of profit margin growth. The other last thing I'd say is what's really important is just the broader commentary we're getting from companies in earnings season to help sort of color the macro landscape in the absence of government-issued data. So far, so good on that front, as it suggests still resilience on the part of the demand side of the economy.